Uh, May I invite Barry now to just introduce him very quickly. Barry is essentially operations, venture capitalist, and investment banker?
No, not yet.
No, okay. Private equity,
Private equity.
all put together. Barry manages one of the best-known seed capital funds out there. That's the Accelerator Fund with Mars, which provides seed capital to early-stage Ontario technology companies. Prior to joining Mars, Barry was with Gekiere Private Capital Group, where he was in transition management. He also had the opportunity to head an aerospace component company. Besides, he was a partner at Venture S, where early stage technology investments were made in IT, communications, clean tech, and medical devices. He's on several boards. He's on the board of Canadian Venture Capital and Private Equity Association, as well as IDF. Please help me welcome Barry.
Thank you very much. All right, thanks. Okay, sorry. Okay, in case I need that, or I can do this here. I'll do that. Done. All right, first of all, I'm going to just give you a little brief advertisement for the Investment Accelerator Fund. We are a seed-stage fund. We're financed by the Ontario government. We look at companies, early-stage companies, and we look for technology-based businesses, and we can invest up to $500,000. The companies that we invest in have to have less than $500,000 in revenue and less than $500,000 in net tangible assets, but we're always looking for new opportunities, and we will get involved with companies at a very early stage. If it still isn't something that we are interested in, we then can refer you to resources within the Mars and other Ontario networks of excellence, and even within the Thai community, within Thai, where there's a lot of assistance that can be given to entrepreneurs. So we try to work with you in some way. Now, I'm a technology-focused guy, and my presentation is sort of technology-oriented, but I'd like to know how many people in the room here are really not looking at a technology business, but are looking at something outside of the technology sector.
Not too many.
So how many looking at not too many? Okay, well, there's a few here. So I'll try to generalize my comments. Can I just put this back onto here?
Yeah.
Good. So, and what also, I noticed that there's some really, really good resources here that are provided by Thai that will give you the details. So I'm going to try to keep this at a relatively high level. I'm going to try to do it quickly so that we can have questions afterwards. I think it's always better to be more specific and try to answer what you're looking for. So, first of all, raising capital, and this should be equity capital because Suresh is going to be doing the debt side of it, but as Jim mentioned, this is a very difficult environment. It's a funder's market. They say those have the gold, it's like the golden rule, those have the gold will make the rules, and it's a very tough market right now. The venture capital industry in 2010 raised the smallest amount of capital in the last 16 years, and in 2011, year to date, it's down 46% again, so there's very little capital available. And it's making it that much more difficult to raise capital. And it's never an easy task, but it's even, as I say, significantly more difficult now. So really the opportunity that you have has to be compelling. You have to have a compelling opportunity, and it's not just to the user, and to users, not just in the eyes of you and your friends, because I always look at it when people come into me, or I have an idea that I like, I also have to remind myself I'm a statistical sample of one. I'm maybe the only guy that likes that. So you really have to go out very early and test your ideas. Test it with potential customers, test it often, get feedback, and try to evolve your product. But make sure that you're out there talking to people, the opportunity, and that you're going to make it compelling to the customer. Also, seek knowledge and advice, and it doesn't have to be expensive. Again, there's a lot of resources available for early stage companies and for startups, and utilize those to the fullest extent that you can. So within the one network, which is Ontario Network of Excellence, there's these innovation centers. There's Mars here in Toronto. There's a new one called Venture Lab up in Markham. There's Communitech in Waterloo. There's Oakry in Ottawa. There's just a number of areas you can go in. You can get access to experienced business people that you can use as a sounding board. You can talk to them about your business plan, what you're thinking about doing, and get some feedback. And they'll give you direction and give you assistance and work with you and continue to work with you if they see promise and you're moving that ball forward. If you're not willing to move the ball forward, then you're not an aggressive entrepreneur and they probably will stop working with you. But if you're moving that ball forward and looking for more information, there's people out there that can help. And I suggest that, even though it may be free, that you should be listening to it, because there's going to be good advice coming through. And for a lot of the companies that we've invested in at the Investment Accelerator Fund, they've really come through that process. They've been able to develop and hone their business concept and idea to the point where we look at it and say, yeah, there's something there that's viable that we can then make that investment. And it's going to be twice as hard and take twice as long as you think. And I'm not trying to discourage you from going out and trying to find equity capital, but that's just the reality of today's marketplace. And therefore, you have to be prepared. You just have to be, it has to be tight. You have to have the best business plan. You have to have that compelling value proposition. You have to be able to articulate that. But you really have to be extra prepared in this environment and trying to raise capital. So attracting investors. As I mentioned before, you need to have a compelling opportunity, but you also have to have a very compelling pitch. And so when you come into the venture capitalist, it's as Jim was saying, he sort of flips to one section and looks at what the management team looks like. When we come in to hear you pitch to us, before we even ask for your business plan and look to your business plan, we want to know that, we want to get a good sense of what you're doing and how compelling it is. And I had a gentleman from Harvard University one time. We were at a presentation where companies were being asked to come up and pitch in 2 minutes. And I said, it's a short period of time. How can you describe your business in 2 minutes? And his thing was, if they can't tell me in 2 minutes what's important about their business, make me understand it, what's important, and why I should invest, and they have to do it in terms that my mother can understand, then you don't have a business. And I thought about it, and I thought, that's probably pretty good. That's not a bad level of advice. So when you come into the venture, to anybody tracking to investors, you have to be able to grab their attention quickly. It has to be compelling. You have to get that point across. What is significant about my opportunity, and why should they be interested in my opportunity? So you really have to do the significance of your product. That's, I think, one of the key items that we look for. And I call it sort of the who cares, like who really cares about your product. And the gentleman over here had a very good question with respect to the status quo. Because the first thing I'm going to challenge you on is what's significantly different about the way it's being done right now. And you have to be able to tell me that. And it has to be compelling. Otherwise, it's just not going to fly. So the significance of the product is important. Then the size of the market. How big is the opportunity? Any investor coming into this wants to see that they're going to be able to make a significant return on their investment. So how big an opportunity do you have that I'm coming into? And you've got to be able to define that in better than just, well, it's a big market. So I love these things that go back into the industry stats on a market, and it's $1 billion market. But when you drill down, they're only addressing a very small part of it. So it really comes down to what I always like to do is say, what's your average selling price? Or what do you think the average selling price of your product is going to be? And then we start putting it into customers, and suddenly you see that market shrinking quite a bit, whereby their average selling price of their service in that large market isn't really that significant. And the number of customers they realistically can get in a certain period of time are just going to shrink that market. So it sounds like a simple test, but a lot of entrepreneurs coming in don't really go through that. And why your team? Jim was pointing out, he looks directly at the team, why your team? What do you have? What are you going to be able to do that's going to make it different in execution? And a lot of times there's great technical talent in the team, but it is all about sales at the end of the day. And so you got to be able to show the entrepreneur how you're going to be able to take that to market. And the go-to-market strategy is usually probably the weakest part of any plan, or the one that hasn't been thought out as well as it should have been. So you really have to be on top of the go-to-market strategy. I haven't mentioned business plan here, but it is very important. And then we start to drill down into the business plan. And we want to make sure that, again, that's focused. I hate saying a 42-page business plan. I just don't think you need that. I'll drill down into detail later on, but even the business plan should be fairly succinct. The most important section, again, that was talked about earlier, is the competition. Who is the competition? And what's your competitive advantage, and how are you going to position yourself against the competition? And don't forget about the status quo. And then financial forecasts. And again, be realistic here. We had somebody come in today. This is the best one. They always say it's a hockey stick, a forecast where it sort of ramps and goes up. This one was a rocket. It went from 0 to $9 million of EBITDA. And we were laughing. It was a great presentation. We had a great presentation until we got to that slide. And then we went, you're not going to be able to ramp up one company to make $9 million in EBITDA in 1 year. So be realistic. Look at the size of the opportunity. Really track it out as to, again, what I'm saying, the number of customers that you're going to be able to have to look at. Look at the sales cycle that's going to be required, how long it's going to take to make that first sale, and take that all into account. Okay, so how much do you need? When do you go raise the capital? And at what cost? So how much do you need? So my question is, when somebody says, how much do I need? I'm just saying, how much do you need to be successful? You have to determine how much it's going to take for you to achieve a meaningful milestone in your business that's going to help you raise more capital, or that you're going to be able to attract paying customers, which tends to be a very good milestone that you need to get to, or how much it's going to take to break even. And you have to know that amount of capital, and you have to go out and raise that amount of capital. So with the Investment Accelerator Fund, we see a business plan that really shows that you need $1 million to get to a meaningful milestone that's going to make your company have greater value, that's going to allow you to go attract your next round of capital, and we can only give you $500,000. We won't invest until we can find another $500,000 for you. Because it's foolish to go with less capital than you need to hit that milestone or get to profitability. So you have to have a good understanding of how much capital it's going to require to get to that point, and then you have to go out and raise that amount of capital. Therefore, you need detailed projections, and the cost side of it, I'm always saying, is relatively easy. It's more controllable. You're going to be able to identify what your costs are going to be to sort of get your business going, but it really is all about your revenue, when you're going to get to revenue. And revenue or a sale doesn't necessarily equal cash. There's such a, there's accounts receivable that can tend to be a little bit longer. So even managing when the cash flows are going to come in, you have to put the right assumptions on just when you're going to be able to collect that cash. You have to look at the length of the sales cycle. How long is it going to take me to, realistically, my salesperson, if he's really good, how long is it going to take him to make a sale? How many sales can he make in a month? And therefore, is it realistic as far as the revenues that I'm projecting on a monthly basis, given that sales cycle? And if I am going to be needing significantly more sales than that one rep can handle because of the length of the sales cycle, I'm going to be needing to put more reps in place, and that's going to increase my cost. So it's that kind of granularity that we look for. Again, getting down what's the average selling price, and it's missed in a lot of business plans that we see. We just don't see that attention to the detail. The next thing is take as much as is offered. In other words, when someone comes, one investment banker that I knew that said to me, when they're passing around the cookies, you take as many as you can get, because you never know when they're coming back with more cookies. So again, if you're raising capital and we've had this, we're going to offer somebody $500,000, we can do that. The question is, well, what if I only took $250 now and $250 later on? Take the $500,000 now. Don't worry about the dilution aspect. It's not going to be that significant in the big picture, as Jim pointed out, if you're going to be building a significant company. So again, what I always say to people is that 10% of a success, if you have the right amount of capital to be successful, is worth more than 75% of an orphan company. Because if you miss your milestones or you don't hit what you expected to hit, you're not going to be able to raise that next round of capital. You could have had it in your pocket to give you more runway. Make sure you've got it. And what costs? How much? What's the value of my company? Well, the market will determine the value of your company. No matter what you think your company is worth, it's going to be the financial the offers that you get, and that's what will determine the value of your company. You should be knowledgeable. You should try to get as much information as you can and talk to people as to how these companies are valued. Get an idea from others, and this can again come from knowledgeable people in the industry as to what the benchmarks are for your company. But you're not going to get significantly more than that. And if you focus on that, as Jim's pointed out, you're sending the wrong message to the investor. We want you to focus at working at building the business, and if you can build a significant value in your business, it won't matter that much at the end of the day. And then the sources of equity capital. What we're seeing now, again, because the venture capital situation is so tight, that really more people are calling on friends and family to provide that first level of investment. And it's not who you like to be able to call on, but it's really becoming a necessity in this market, where you have to be able to show that there's willingness to put in some equity on your own, to commit your own assets, or from friends and family, and try to raise that amount of capital. So the Investment Accelerator Fund, we're usually going into companies that have done that first step. The next step, once they've sort of got it to a point where it may not be a fully completed product, but we can see and touch something, we know at the market that they're going after, they've got some feedback from some initial customers, then you need to target the angel investor community. It's today's best source of capital. It's the most active area. There are high net worth individuals that are looking to make investments in these companies. They're entrepreneurial. They're not always easy to find, but you also want to find ones that get it. So if you have a company, and I look at this on Dragon's Den, where you'll see people that they'll focus on one person because they're trying to do something to the restaurant trade. So they go to the guy who founded Boston Pizza because he gets it. And that's very important. So look at your business, try to find high net worth individuals through a network that will understand your business, and that will speed up your access to capital. There's a number of government programs available. Most of these are focused at technology companies, IRAP programs, SR&ED. Once you're in business, there's Ontario Centers of Excellence, which are doing things for mostly companies that are out of university spinouts. And they have some small programs to help companies to go for commercialization, for embedded executives. Mars also has small amounts of capital available, etc. But there's actually a website that I come across recently called what's it called? Wait a second. It's called the Funding Portal. It's called thefundingportal.com, and it actually gives you a little bit of a criteria. You can put a little bit about your company and where it's located, and they've got 2,200 government programs in total that they can pull from and show you whether there's anything that's applicable. So I will leave you to sort of use that, but there are a number of them, and again, you can talk to Ty and talk to Mars and be able to tap into these resources. Venture capital is the toughest to attract. It's probably, you need to be in a situation where you probably have your first customer, or you're at least along in that process. And I've thrown on here something called an RTO, which is a reverse takeover of a public shell. And we see sometimes companies that have sort of a hot product, they think it's sexy, and there's going to be a lot of interest from the public sector. And we caution against this because it's a situation where you go and you can raise some quick money, but then you're just sort of orphaned. No one's going to pay attention to you. And most venture capitalists or other investors won't come into these kind of investment opportunities. So it's not used very much, but if anyone's knocking on your door saying this is something you should consider, come talk to me because I'll tell you reasons why you probably shouldn't. So I'm not going to take up any more time. That is sort of my comments, and I'll leave it open to questions. Yes?
So what I'm finding strange is that the model seems to be twisted. Venture capital is supposed to be high risk money available for trying out new stuff, right? But the VCs, the way they are acting, so if the venture money is say 5% of pension fund which is allocated for this purpose, and 30% in government bonds and 40% in other security investment, so this fraction is supposed to go to high risk businesses which are at very infancy stage. They have to prove their business model, they have to struggle along. But you go and talk to VCs, the impression you get is, well, they want you to be more mature than what you are. So they want angels to take the risk, or they want me to take the risk. Then what is the purpose of that VC fund?
Good question.
First of all, what's happened to the venture capital industry in Canada, and a little bit to the US, but a little more in Canada, is that there have not been good rates of return. And money follows rates of return. So those pension funds that were used to be allocating 5% to venture capital aren't doing it anymore. They're saying we haven't made it, and because they can make way more money on private equity investments, where they're private equity funds who go into established businesses, and they can do financial engineering on these established businesses and make great rates of return. So the pension funds have said, venture capital, we haven't seen the rates of return, we're gone. Now, venture capital is a cyclical industry, and there was an oversupply of capital in the early 2000s in venture capital, and the venture capitalists did not make very much money because there was an oversupply. They went into some deals they shouldn't have gone into. It will turn around. There's now an undersupply of capital. There's people that aren't playing in this space, and there will be money flowing in. And the angels are really priming that pump. So they're coming in and saying, we'll take the risk, and they'll make some nice returns. And then you'll start seeing more money start flowing back into the earlier stage. But right now it's just not there because the returns weren't there. So the venture capitalists have also moved up the risk scale. They can't afford to take that, what they see as that very, very early risk. They're saying, I've got to see it a little bit farther along because that's what my investors are. It's extremely difficult because it needs to go through FDA approval. In many cases, it's going to need at least $10 million to go anywhere. So there's no easy answer for that right now. And there are some specialized funds that do focus on medical devices and pharmaceuticals still, but it's not there. And believe me, the government's struggling to try to figure out ways to address this, but there's no easy solution right now. And that's why capital is difficult to find. We had one company come to us that 5 years ago or 6 years ago, it was in a space that would have had a lot of attention, but it's in fabless semiconductors, and now it takes 10 to 20, probably takes more than that, probably takes $20 to $40 million to build a business. And there's just no appetite for that. So they're not going. It's going to be left to large organizations and companies like Cisco, et cetera, to build those products out, but they're just not going to happen from the entrepreneur right now.
One of the concerns, Jim, and you also brought it up. One of the concerns that both you and Jim brought up, and that is the backing of university-based systems. If I were to take a model of what was most successful companies prior to our current situation, they were all headed by people who didn't come out of the universities, who were dropouts. Right? So the concentration on just that sort of segment where it comes out of the university as opposed to being able to understand the opportunities that are available. I ran into this last week. It's a contrast between cost and value of the investment. I see more and more instances where people are concerned about the cost of making this investment as opposed to the value of the investment if it makes any headway. Right? The examples I was thinking of is Bill Gates, Steve Jobs, and I think the head of Larry Ellis. I don't think any of those came out of the university, and yet they're the largest software companies in the world. Now, my background is in software, so that was the reason.
No, I won't dispute it. I mean, I think whether it comes out of even if something comes out of the university, I know that's easier to find funding sometimes for something that comes out of university because there's more government programs to support that, but it doesn't necessarily mean it's going to be a success. So I think everything has to be viewed on its merits. And again, I think most venture capitalists will look at the merits and look at the people behind it. So I think they look at sort of the skill sets and whether they're the right person for the position. Anything else? Any other questions?
Barry, it's a bit of a chicken and egg situation where the venture capitalists don't find a return because where they invested, the companies didn't do too well. So how would you compare the past few years' performance to those companies who were funded by venture capitalists?
How do I compare the last few years compared to before?
Compared to elsewhere?
Oh, but here, you mean?
Yeah, in Ontario.
You mean as far as the quality of the companies here in Ontario?
As far as their performance is concerned?
Well, I think what you're seeing now is you're seeing better performances of the companies, better performance from an investment point of view of the companies. Because what's happening right now is that, so the Investment Accelerator Fund, we can only make 12 to 15, I shouldn't say only, we make 12 to 15 investments per year, which is a lot for a seed stage fund. And we're looking for the 12 to 15 best companies in Ontario. We're getting a very good selection. For a seed stage fund, our performance will actually be very good because there's a lot of good companies out there that aren't able to attract capital from other sources. So we're seeing a very good level of quality deal flow. So anybody who does have money and is willing to invest it at this time in the sector, I think is going to do quite well. Our companies, I think there's some really bright people that we're seeing that are building world-class companies. I think it's always been the case in Canada. I think the challenge that all of you have, or anybody here in Canada, is that you have to be able to market internationally, and you have to, and that's our biggest challenge here. Is that they always say, why has Israel been so successful? I think Israel's been so successful with their venture capital companies because the first thing they do, they know they can't have a sales marketing office in Israel. They've got to bring it to North America, and they've got to put it in the States. And therefore, they're honed and they're aggressive in their sales and marketing tactics for the U.S. We tend to be a little bit more conservative here and try to target it from Canada. So that's one of my issues. I think we have to figure out ways to get our market and look at the North American market beyond just Canada to really build some really great world-class companies. But I think we've got great technology here. I think there's good people. We're seeing U.S. investors coming into our companies. We just had NGen out of a clean tech company we have come in out of the States and made an investment. We've had just recently, it will be announced shortly, one of our other companies has had a strong U.S. partner come in. We've had another company recently that Citrix made an investment in out of the U.S. So we've got great companies here.
Barry, you mentioned that you also look at the size of the opportunity. Will you be a little more specific as to percentage of market share, or how do you look at it?
I guess we look at the total size of the market opportunity and then what reasonable percentage market share we think the company can get. We have the Investment Accelerator Fund, because we're not looking at just rates of return, we can play in niche markets. So we back some companies that venture capitalists would not look at, But we've determined that there's a large enough market there, and their business plan is strong enough that with the capital that we're providing with some angel capital, they can get to where they need to get to make a sustainable business. So what we're looking at doing is building profitable, sustainable businesses in the province. They may not have to be worth $100 or $250 million. But the problem that you face when you talk to venture capitalists, I don't mean to be going over here, but when you talk to venture capitalists, you have to understand their metrics. So I'm a venture capital fund, and if I'm a large venture capital fund, I want to invest $10 million in a company because I don't want to be making all kinds of investments. I want to focus on a few, and I'm going to invest $10 million. I'm going to get, I don't know, 25, 30% of your company or 40% of your company overall. But if I want to make 10 times my money, I'm looking to take $100 million out, and $100 million of it, your company's got to be worth $400 million, or at least $200 to $400 million, for me to be able to take that out. So I've got to build huge companies. If you're going to be a $25 million company, it's not going to turn my dial. So I can't play in that. So it also limits the number of the types of companies that go into. So, but that's where the angels come in, because the angels look at it and say, we're going to be much more capital efficient. I'm not looking to put $10 million in a company. I'll be happy if I can put $1 million in a company and get a 10 times return. So the metrics are different, and therefore they're much more in tune with the entrepreneur in some of the niche markets that some of you may be developing businesses in. That's it.